So chapter 9, as I talked about yesterday, is all about receivables. So an asset that is very much under the watchful eye of someone, so we get paid eventually. The first section's super fast. It just talks about, well, what are the types of receivables? And there's really, it boils down to 3. Anytime an amount is owed by a customer that results from the sale is an AR. So it's the kind of, hey, I want to buy this. I don't want to pay cash, but I'm going to pay you with some terms, 2, 10, and 30. It's probably the most common term. Anytime that, well, this is a really fancy definition, but anytime there's long-term debt involved, a claim for which formal instruments of credit are issued as proof of debt. So in other words, it's not just a quick turnaround, it's more of a long-range receivable. It's called a notes receivable. And then the chapter even introduces other. So non-trade things like loans to officers, advances to employees, maybe income taxes refundable are considered other receivables. What you need to know, though, these are more short-term. Notes receivable are more long-term. Notes receivable is us loaning money, typically, that will be paid back over a long length of time. What does this look like on a, oh, I got a little ahead of myself there. They brought in some, I don't know if the chapter talked about this, but they brought in some examples. Look at General Electric. 52% of their assets are tied up in receivables. That's scary. Versus Intel, what does that say? Do they let people charge a lot or not, Intel? No, because only 5% of their assets are tied up in receivables. So in other words, these floating balloons that are out there floating, full of eventually getting paid. General Electric has a lot of balloons floating around. Intel, not so much. That's all of the first section. The second section could take days to get through. We'll see how far we get. So it rolls right into some journal entries, and I would assume this is in your supplemental notes. You're going to read this entry and go, how is this any different than what we've done, Mrs. Mars? Assume Jordache Company on July 1st sells merchandise on account to Polo Company for $1,000 with terms that on account and terms definitely is an AR. If we're selling something to someone and they're not paying us cash and we set up terms and it's on account, it's in the AR, prepare the journal entry. Now notice what I have in red. It says sell. We sold something. These entries are the same as what we did in chapter 5 when we sell stuff, but for simplicity of this chapter, they're leaving the second journal entry out. So you know how when we sell something, it's either we get cash or AR goes up, and then there's sales revenue, followed by COGS goes up and inventory goes down. They're saying we're going to just keep it simple for this chapter, and we're going to not forget about that, but we're not going to journalize that. Does that make sense? To me, it really doesn't make sense because they should make you do that step, but they're just simplifying it. So just because we sell something in this chapter doesn't mean, because normally it would have been like AR is debited, sales revenue is credited, but because we sold something, COGS goes up and inventory goes down. So just for simple here, like if we sell something, remember how it would be like, it was 65% off, yeah. So then the stuff wasn't free. So they're saying we're going to omit that bottom part. Okay, so you just saw me do the entry. July 1st, AR goes up, and we sold something. Sales revenue also goes up. Not like, I mean, this is one of the first things that we learned, probably in chapter 2 or 3. And then we complicated it in chapter 5. Now they're taking the complicated part away. That's it. So if I had to make a T account for AR Polo, it's an asset, so it went up. What's happening just a few days later? On July 5th, what did Polo do? Why did they return $100 worth? Who knows? Maybe they changed their mind. Maybe it was junky. Maybe whatever. So then we have sales returns and allowances. But do they owe that whole amount anymore? No. They returned a little bit. Sales returns and allowances is what's called a contra revenue account. If I go back, and I'm not trying to make you dizzy there, if I go back a slide, we had $1,000 in sales revenue. But if the stuff came back, we have to contradict or contra that in the form of sales revenue. You get sales returns and allowances. Do you remember doing that in previous chapters? Good. So a few things. Did we really earn $1,000? No, because of this contra revenue account, we've really only earned $900. Does AR still owe $1,000? No, they only owe us $900. What's happening on July 11th? We got paid from who? Okay, but remember the terms we set? We said, yeah, we'll sell this to you, 2, 10, and 30. So on July 1st, when were we going to allow the discount period to go through? 10 days later, so the 11th, look when they paid us. Are we going to get $900? We are going to get $882. Why, when they owed us $900, are we only getting $882? Where'd you guys come up with 2? 2, 10, and 30, the terms. So they originally did this on July 1. They just sneaked in on the 10th day, and that's the whole 2, 10, and 30. We are allowing a 2% discount because they paid within 10 days. So we see another contra revenue account. It's called sales discount, and we came up with that by taking 900 times 2%. But AR truly was wiped out with a $900 credit. So 1,000 equals 100 plus 900. I'm kind of old school and like those T accounts, just so you can see where the numbers came from. Now let's go back to the original sale. We originally sold $1,000 worth of stuff, but now we've had 2 contra assets chop that up, didn't we? We allowed them to return and we allowed a discount, but you know what? They're probably going to be a pretty loyal customer because we allow those things. Would you agree? So is it okay to take a little $18 hit? Because now we don't have that balloon floating around anymore. They paid their bill. It's a good thing. None of what I just showed you was new. We've done this before. It's just kind of like, oh yeah, that's how you do it. Let's throw this one in there. Assume you owe $300 at the end of the month and your retailer charges 1.5% on any balance remaining. Sounds a lot like a company credit card or like a Shields credit card or a Cabela's credit card, right? When you go run around and apply for retailer credit cards and you don't pay your bill off every month, you get a little interest on any remaining. So what would the entry be for the retailer? So let's just say Cabela's in this case. We had a $300 balance remaining on our Cabela's credit card. What entry would the retailer make for that 1.5% balance? AR goes up, interest revenue goes up. Where did they come up with $4.50? 300 times 1.5%. must be $4.50. AR to Cabela's is us. This is us. But we're not us. Okay, we're talking Cabela's. We're talking me running around swiping my Cabela's card. Do I owe that $4.50? Yeah, because I originally owed $300, but now I didn't pay off my bill, and Cabela's is going to charge me 1.5%. I don't think Cabela's has ever charged 1.5%. It's probably more like 20%. Retailer credit cards are notorious for having super high percentage rates that they're going to slap on you as a fee if you don't pay your bill. Interest revenue is often substantial. Why? I'd say two big reasons. Cabela's, Scheels, Old Navy, Gap. Why do they make so much money off interest? I'd say there's two reasons. Take a guess on one. First of all, these retailers charge very high percentages, way more than 5%. I would say those typical store credit cards are like between 15 and 20%. That's icky. And they suck you in. They're like, here's a free t-shirt, here's a chocolate bar, here's a whatever, whatever, whatever. And nothing against the people at the tills, but they automatically are just, are you interested in saving 10% by opening up a store credit card today? No, I'm not. Gross. Let that go. So that's one reason. They charge really high percentage rates. And the other reason is us, as Americans, as consumers, we love debt. Not everybody, but a lot of people do. And they don't pay their bill. Don't pay in full. So not only are these retailers charging super high percentages, but we as Americans are running around with credit card balances. So that's why interest revenue is a big money maker for people like a Cabela's. Welcome to the United States of America. So let's pause and do a couple exercises before we get into the balloons. Before we get into direct write-offs and allowance for doubtful, which I like to have a different name for, allowance for hopeful. Let's do two together. I would assume you have workbook pages, and you'll want your textbook as well. We'll do a shout out to Carly. I hope she's got her toes in the sand and has maybe on her way to a luau. So hi, Carly. It's, 0 degrees here, and we slip and fall in the parking lot because it's icy. Jenna almost did that yesterday, if you didn't hear her say that. So we hope your most tragic thing is you just don't know the next fun thing you're going to do in Hawaii. All right, so exercise 9.1. I am on page 455 in the book. Oh man, I have all sorts of sticky notes and writing all over. We'll see here. Okay. Presented below are selected transactions of Molina Company. Molina sells in large quantities to other companies and also sells its products in a small retail outlet. Prepare the journal entries for the transactions. So sold, I see the word sold. Always in the past that triggered 2 transactions. Are we worrying about the second half of that anymore? No. I think we should, but I'm not the textbook writer, so whatever. March 1st, we sold merchandise on account to Dodson, $5,000 worth, and there were terms. So did Dodson pay us cash? There were terms. So you will see AR, specifically Dodson Company, go up, and sales revenue go up by $5,000. I don't want to move my recording thing, but you know what the debit should be. They did not pay us cash, rather the AR went up. So we got ourselves a balloon out of the deal. A pretty big balloon. $5,000 now is owed to us. Okay, is that an asset? Yes, it is. I have magic balloons. Do you guys see that? Partly you're missing out on my balloon fun here. You can put AR and Dodson Company there. You don't have to spell it all out like that. So I am going to make a tiny little T account for Dodson. They owe us $5,000. Why is that an asset? What part of that do we own? The right to getting paid. And I hope we have a really good AR department who will stay on it so we get paid. We had sales revenue. Do you think we're going to have some things that chop up our sales revenue? What's your guess? We're going to let Dodson discount because of our terms, and they probably are going to return something. Well, lo and behold, March 3rd, they do. Dodson Company returned $300 worth of merchandise. So they no longer owe us $5,000, and our revenue of $5,000 got karate chopped with a contra revenue account. What contra revenue account allows for this to happen? You guys remember? Sales returns and allowances. And again, I'd like you to write somewhere next to that contra revenue. Notice revenue has a credit balance, so when we throw a debit in there, it's contradicting what happened. Who doesn't owe us as much money anymore? Dodson, so AR Dodson Company. So if they paid today, they'd have a $4,700 balance. And if they paid today, they're going to get a discount. What was the original term set? 210 and 30. So on March 1st, when does their 210 expire? March 11th. But look what's happening. We collected the amount due from Dodson. They paid 2 days early. So we knew they were rocking a $4,700 balance. Are we going to have $4,700 cash in our pocket? No, they paid within the discount period. So what kind of discount are we going to give them? 2%. So we actually got $4,410 in cash. What? They owed us $47,000. Why am I not getting the full? Because we allowed a sales discount of $90. So $4,700 times 2%, $90. Sales discount, if we had to put a label on it, what kind of label would we give it? Contra to what? Contra revenue. So we originally sold $5,000, but we had one contra revenue kick it apart because we let them return, and we had another contra revenue kick it apart because we gave them a sales discount. I bet they're going to keep coming back to our business though because we have incentives. $4,700 though. Well, am I doing my math wrong? Why is it 45? Oh, I put my guys didn't catch me. Didn't it say 300? 500. No wonder you guys were giving me funny looks. I thought they returned 300. No, they returned 500. Durr. Sorry, I had my return wrong. Did you guys see my error? Okay. Sorry. Looks like we're going to keep selling. Molina sold merchandise for $400 in its retail outlet. The customer used their Molina credit card or their Cabela's credit card. So they must have a store credit card. AR goes up, sales revenue goes up. So even though it's a credit card, it's attached to the business as owing. Does that make sense, you guys? Think of it like a Cabela's card or a Scheels card. In this case, they're using their Molina card. So they swiped it at the till. There were no terms this time because it's all on a credit card. but Molina added a 1.5 monthly interest to the credit card balance. So AR is going to go up again, and so is interest revenue by $3 whopping, because we have our $400 store card times they're charging 1.5% on any balances that remain. Just because we didn't pay our bill in time, they're going to earn an extra $3 on us. Not very much here, but in the real world, these store credit cards are upwards of 20%, like I've told you a couple times. And then for people who don't pay their bill off month after month, that's big money earned. Why is it not sales revenue? Why is it interest revenue? Notice the difference there. Did you guys see? The first one was sales revenue when we sold stuff. Why is this one interest revenue instead? We didn't sell them anything. We just are charging them interest on what they didn't pay. So notice that difference. Easy? Let's try exercise 9-2. Would you like me to do this one with you? Or do you want to try it on your own? It doesn't look the same. Prepare journal entries for the transactions below. I think you can do it. It's just they're slamming them all in together. So like on January 6th, Brumbaugh sells merchandise with terms. And then January 16th, they paid the amount due. See how they're just, it's just putting it all together? Why don't you try it? I'll go through the answers. Do they have the dates on there for you? Okay, well that makes it easier. Let's do it. So I'm not even going to look at the book. I'm going to test my skills up here. I see that AR to prior went up, with sales revenue went up as well. So I assume prior bought $7 grand worth of stuff and charged it. Normally we'd see an additional COGS in inventory, but just remember we're not doing that for this chapter. Hi. Then on the 16th, they paid. So they didn't return anything, they just paid. We see a contra revenue account go up to offset the revenue. Why is that a contra revenue account? Why is a sales discount a contra revenue account? Takes away part of the revenue, and a debit would offset a credit. So they didn't pay us the $7,000, although that wiped out their AR. They paid us the difference of AR, what they owed, and their sales discount. I think that must be all of A, right? What's going on in B? AR Farley went up $9 grand. And Farley paid $5 grand back in February. So he still has a balance of $2,000. So there's a balloon hanging around. It's been deflated a little bit, but he still owes us $2 grand. And, or did he do a store credit card? Store credit card? Okay. I can tell because now all of a sudden we have interest revenue in there. So we only charge 1% on balances. So the reason it's only 40 is because the difference of $4,000 times 1%. Why is it not sales revenue? Why is it interest revenue? You earn interest on that balance. And it's a different form of money-making revenue. Okay, should we keep going? What's our time? Oh, fabulous. Okay, so we are going to go back to our lecture. I get really excited about teaching this next section because I get to mess around with balloons up here. So, fine and dandy when they pay their bill. Like everybody's been paying their bill, or if it's a credit card, we charge extra interest and earn more revenue called interest revenue. What happens when these balloons go bad? Do you think it ever happens that people just walk away from their bill? All the time. And what do you do then with that amount owed? You can either write it off. You can either write off the AR or you can do what's called the allowance method. GAAP, so the generally accepted accounting principles, does not like the write-off method. They don't like it. GAAP is much more favorable of the allowance method. I always call the allowance method the hopeful method because we're hopeful that we can recover our money. In the cases that we just saw, $9,000, $7,000, that's a lot of money. That's a lot of ARs tied up in balloons. Direct write-off really messes with the revenue earned. It's going to make income look really good in one year and really bad in the next year. But sometimes you just have to give up on a person and eat the loss. The allowance method does have better matching. So in other words, it's matching the revenue to what it truly is, but it's much more GAAP approved. In relation to balloons, the direct write-off is a dart to the balloon. So if I'm running around here with these ARs floating, like people owe us money, and I decide to write one off, here I go. I'm going to just, I had to scare you this morning. I've been ready to punch on that. We're going to just say, we're done with you, AR, and now you're garbage. Like, we're not going to get money out of you. Would we be able to put air back into this balloon? We wouldn't. A direct write-off is just like a dart to a balloon. We're done. The allowance method, and I had to leave this one deflated because it wouldn't keep air in it. If we are using the allowance method, we still have an AR, in this case a balloon, but we are just deflating the balloon instead. So if I say, if we're using the allowance method, we're not going to dart this balloon, we're just going to let the air out. Could I put air back in? Yes. This AR, it's dilapidated and wrinkled and ugly, but at least if they come knocking at my door and say, we would like to pay you, I could blow the balloon back up and get their money. Do you see why GAAP likes this one better? And do you see why I call it a hopeful one? I hope that this AR comes back to me and says, please let me pay you. If this AR comes back, this is a mess. This is a dart to a balloon. Okay. I think for the next few weeks, every time you see a balloon, you're going to think of direct write-off and allowance method, because it just visually, it also, if I had helium balloons right now, I could be walking around with these balloons and they're like ARs floating in air. And this is a huge liability, and I don't mean to use the word liability in an accounting class, but this is a big deal for tied up assets, because this is an asset, but it's tied up floating. And we saw General Motors has 52% of their assets are these that you hope you don't have to dart. That's a big deal. Here you see visuals again. I'm not just making up this balloon thing. It came with the chapter, but I like popping balloons better. Okay. With the direct write-off, I'm selling. Woohoo, I'm selling. I've got all these sales. They're tied up in ARs. 1 year, it looks like we made a bunch of money. Because if there's ARs, that means we sold something. And woohoo, look at all our sales. But then the next year, if none of them paid and they're all darted, the next year looks like we have a net loss. And we didn't get any of our money. So it's really extreme. Like 1 year is really good, and then dart, dart, dart. Next year's really bad. All our balloons are deflated, hanging, or not deflated, popped, laying on the ground. Versus if in 1 year we made sales and there's 3 balloons, but we just had to deflate one, it's gone, but we could reinflate it if we had to. So as far as how do these two methods impact the bottom line or net income, 1 year is really good, the next year is really bad. But with the allowance, 1 year is really good, the next year is just not quite as good. But we could reinflate it if we had to. What does it look like on the balance sheet? You are being introduced to another contra account, but the allowance for doubtful accounts is a contra asset. You know how we've had contra revenue accounts so far that offset our revenue? Now we're going to have contra assets that offset our assets. So if I had $500 worth of balloons running around, maybe it's maybe one's $250, maybe one's $100, and $150. That equals $500, doesn't it? Yes. So if I'm running around with my $500 worth of balloons, meaning those people bought from me and they have not paid, we can estimate that we're probably not going to see all that money back. And in this case, some higher power that be, some upper management person is saying, out of the $500, we're going to just historically, maybe based on some fancy math figure, but we're probably saying out of $500, we're probably not going to see 25 of that, just because reality strikes and people just don't always pay their bill. So instead of running around with $500 worth of assets, we're going to offset that by probably not going to see $25 out of that balloon pile. And instead of writing it off, we're just going to deflate it. So we hope that eventually we will get paid that 25 bucks. But we have this little floater account now that's saying we're not floating up in the air, la la la. We're realists here. We know that probably not everybody's going to pay their bill. So here's what it would look like. On a balance sheet, we've got AR, but less the contra asset to say if we've got these $500 in balloons floating, probably only going to see 475 of it because these bad eggs are probably not going to pay us. Where'd they come up with the 25? People who sell on account a lot can gauge who's not going to pay their bill. Another way to look at it is all on one line. So instead of breaking it down, AR less the contra, you can put it on one line as well, AR net the 25 allowance. I like this way better because that's how equipment is. You'll get into that with our depreciation unit or chapter here coming up. I like the 2-line item. It lists it a little bit cleaner. This is an okay way. I just think we should do it line by line. So that's when you use that left account or left column to do the math to equal the 1. Honestly, this is a really good time to stop. Because we've talked about this, I think getting into the journal entries would be a really clean start next week. Now here's the scoop, you guys. I'm not going to see you till Monday. Because I won't be here tomorrow. Some of you are going to stay BPA. Carly's still in Hawaii. So I think just it'd be a good clean stopping point. We're going to just start journalizing what this looks like, though. I just want to preview it. Assume that Warden writes off. That's a DART. Some credit manager estimates that these are going to be uncollectible. That's the deflated balloon. Or hopeful that we'll get those doubtful accounts recovered. So we'll get into like seeing how those look journal. I think it would be good to review this kind of stuff. Let me backtrack out. I think it would be good to review on Monday and then just start. What do you guys think?